In today's video, I'm going to be covering the 2025 FHA loan requirements. I'm going to go over some FHA basics, and I'm also going to go over how to calculate a monthly payment on an FHA loan. So if you're curious about how to buy a house with 3.5% down, and maybe you don't have the best credit score, you need to get educated on the FHA loan. I'm Darren Sy. I'm a licensed real estate agent and loan officer in California, and I'm a big believer that home ownership provides stability and helps many families grow their wealth. Before we dive into the FHA loan, I do want to say, make sure before you buy a home, it's at the right time for you and your family. Don't just buy a home to buy a home and end up losing it. I want to talk about a few myths about FHA loans, right? The first is that FHA loans are for first-time home buyers only. That is not true. You can have multiple FHA loans depending on your scenario. Another myth is that FHA loans are only for people with low credit scores and low down payments. That is also not true. You can have stellar credit and you can have a large down payment, and an FHA loan might still be the best option for you. My goal here is to educate home buyers to find the best loan option for them, whether that be conventional, FHA, VA, non-QM, whatever it is. My goal is for home buyers to be educated on all their options. And so today we're talking about the FHA loan because it is a powerful tool for home buyers. You can have a 3.5% down payment and you can have not the best credit score. And that's because FHA loans have more flexible guidelines, right? I've already gone over the 3.5% down payment. You can have a lower credit score and you can have a higher debt to income ratio than conventional loans. So that means that someone with a great credit score could potentially qualify a buyer for more home if they use the FHA loan compared to if they use a conventional loan. And that leads me straight into the FHA requirements. So the first is credit score. Home buyers can have a credit score of 500 and still qualify for an FHA loan. The thing with having a 500 credit score though, and using an FHA loan, is that you cannot put 3.5% down. You actually need to put a 10% down payment instead of 3.5% if your credit score is at 500. Now, if your credit score is 580 or above, then you can use the FHA loan and put 3.5% down. And the reality is, no matter what type of loan you decide to use when you buy your home, the lower your credit score, the harder it's going to be for you to qualify. And in my experience, most people who decide to go with the FHA loan are doing so because they can put 3.5% down. Maybe they have more funds saved up, but maybe they want those for a rainy day. Maybe they want those to invest. So instead of putting a full 10 or 20%, they actually still just put 3.5% down because they can, and they have the other funds for other things that they want to use it for. Here's just a quick breakdown of a 3.5% down payment. So I'm going to start with $1 million purchase. Buyers could qualify for $1 million home with just $35,000 down. Is it recommended? Depends on the financial situation. If they have a ton of income coming in every month and they can meet the debt to income requirements, they could technically qualify for $1 million property with just $35,000 down. So a more realistic scenario that we see all the time is a $500,000 home and someone is putting $17,500 down. And if we look at a $400,000 home, we're looking at a $14,000 down payment. $300,000 home, $10,500. And this is a really common scenario right here. And then obviously if you go to a $200,000 home, it's a $7,000 down payment. For a $100,000 home, it's $3,500 down payment. So if we take a look at the 2024 median home sales price, it's about $425,000. So using an FHA loan, you would need roughly $14,000 as your down payment for the median. So now that you have a quick view of the required down payment on specific home prices, this is going to lead me straight into the next FHA requirement, which is loan limits. You might be wondering, what is a loan limit? So a loan limit just means there's a maximum amount the FHA will loan out depending on the county that you're in. This loan limit changes every year. What the FHA actually looks at is the type of property, the county that you're in, and if it's a high or low cost of living area. So depending on these different factors, they're going to be willing to loan out a certain amount. If you're wondering what your loan limit is in your county, there's actually going to be a link in the description down below. You can click on that, type in your zip code, type in where you live, and it'll tell you this is the maximum FHA loan amount. So for example, I'm just going to share some cities that are close to me. Orange County, The FHA loan limit for a single family home is about $1.2 million. Riverside County, the max loan limit is $672,000. San Bernardino, $672,000 as well. San Diego's just shy of $1.1 million. So like I said, depending on the county, depending on the type of property, depending if it's high cost of living or low cost of living, will dictate the maximum amount of FHA loan that you can borrow. Keep in mind, if the home that you're looking at is above this loan limit, that's totally fine. You just have to increase your down payment to get that loan below the loan limit. So now that we've covered credit, down payment, loan limits, let's talk about mortgage insurance. Mortgage insurance seems to be that factor that everyone says FHA loans are terrible because of mortgage insurance. But the reality is mortgage insurance is a part of the cost of buying a home if you don't have 20% down. Even on a conventional loan, if you don't have 20% down, you're still paying mortgage insurance. And the mortgage insurance on a conventional loan might actually be higher than an FHA loan depending on your credit and your loan to value. And you'll see once we go through the calculations a little bit later in this video, mortgage insurance typically isn't a huge cost and it's pretty manageable on a monthly payment basis. And so one thing to note with the FHA loan is that the mortgage insurance stays with the life of the loan if you only put 3.5% down. So if you put 3.5% down when you purchase your home using an FHA loan, you will have mortgage insurance for that full 30 years. The only way you can avoid mortgage insurance on an FHA loan right now is if you put 10% down. Now, if you put a 10% down payment on an FHA loan when you buy a property, if you put that 10% down, the mortgage insurance automatically falls off after 11 years. You don't have to do anything. It just automatically goes away after 11 years. And keep in mind, at the time of this video, there is actually a bill that is potentially going to be passed changing this. So I'll keep you updated. If it passes, then FHA loans become an even better option because the mortgage insurance, you can put 3.5% down and the mortgage insurance will eventually fall off once you hit 20% equity in your home. That's for a later date and time, but I'll keep you posted. Also related to mortgage insurance, a common question that people ask is, can I refinance into a conventional loan if I purchase my home using an FHA loan? The answer is yes, absolutely. Okay, now that we've covered a lot of the FHA basics, we're going to cover debt to income ratio. And so I'm actually going to just walk through a quick summary of what debt to income ratio is, and then I'm going to help show how you can calculate it yourself. It's not going to be exact, but it'll give you a good idea so you can estimate your own purchasing power. And this is how lenders qualify you for a mortgage. So all the debt to income ratio is your monthly debts divided by your monthly gross income. And when we talk about monthly debts, we're talking about installment debts that show up on a credit report or revolving debts, right? So a car payment, a student loan, child support, personal loans, some things that are not included, right? Your groceries, your utility bills, your health insurance, stuff like that will not show up. And I will go over this in detail. You'll be able to see how to calculate it yourself, but we're actually going to talk about two different types of DTI. The first one is your front end DTI, which is related to your housing expenses. And the second one is your back end DTI. That takes a look at your housing expenses and all your other installment and revolving debts. When we're talking about the front end DTI, we're just going to take into account mortgage payment, which is your principal and interest, your property taxes, your homeowner's insurance, mortgage insurance, and HOA if you have it. And then on the back end DTI, you take the front end DTI and you add to it your monthly car payment, minimum credit card payments if you have any, your student loan payment, child support, or any other debts that have a balance related to it. Now that you have an idea of what DTI is, let's go into the actual details of it. So the first piece is your income calculation. And this is going to be based off of your gross income. And you're probably wondering, why do we use gross income? And the reality is everyone has different withholdings and different taxes. So these lenders, when they qualify, are just using gross. The biggest takeaway from this, though, is you're going to need to know your personal budget and how much you take home. I'm just going to keep this example really easy. You have $120,000 annual income, and that would be $10,000 a month in monthly gross income. The next piece after income is the debt calculation. This one can be a little bit trickier because you might not know all of your installment debts. So there's a ton of reputable resources out there. You can get a free credit report too. But in today's example, and just keep in mind, this is just an example. I'm not giving you hard numbers. This is just for educational purposes. We're going to use an example of a $600 a month car payment, $150 in student loans, $250 a month in minimum credit card payments for a total of $1,000 a month in debt payments. Now that we've gone over the income and the debt piece of the debt to income, we're going to talk about figuring out housing expense. So to help figure out housing expense, I'm just going to use an example of numbers for educational purposes. The home price is $500,000. The principal and interest on this would be a $3,000 payment. Property tax is $500. Mortgage insurance is $200. And then your homeowner's insurance is $100. So with that math right there, that gets you to a front end housing ratio of $4,000. That's just for the housing expense, right? That's your principal and interest, property tax, mortgage insurance, and homeowner's insurance. You take that housing expense of $4,000 a month and you divide that by the $10,000 of your gross monthly income. And that would be 0.4 or 40%. And that is less than the required 47% for an FHA loan. So in that specific example that I gave you, this person would meet the requirements for an FHA loan for the front end DTI. The back end DTI is really straightforward. You just take that 4,000 that we just calculated on the front end and you add the other debts that we had that were 1,000 a month. So in this example, we'd have 5,000 a month for back end debts, and you would divide that by the 10,000. You have 0.5 or 50%, which is less than the 57% that's required by FHA. And full disclaimer, right? This is just an example. I'm definitely teaching you to calculate, to ballpark on your own, but when you're ready to move forward for real, reach out to a licensed loan officer or a bank that will help you run the numbers for your scenario specifically. If you don't know where to find a lender, just email me. We've gone over a good amount of FHA basics, but now I'm actually going to talk about the FHA property guidelines. So first and foremost, if you're using an FHA loan, it needs to be the primary home that you live in, right? You're not going to be allowed to use an FHA loan to buy a vacation home or a rental property, but what many people do is they buy their first home using an FHA loan and they eventually outgrow that home, right? So they use the FHA loan to buy their first home. They've outgrown it. Maybe their family got bigger, or maybe they have to relocate for work. So they keep that house and they can now afford another house. They move out of that first house into their second home and they can actually turn the first house into a rental. And it has an FHA loan on it. That's totally fine. But when you first purchase using an FHA loan, it needs to be your primary residence. Another guideline is the home has to be in good condition, right? So the home has to be safe and it has to be livable. FHA loans can be used to purchase a single family residence, a condo, a townhome, and multifamily up to 4 units. So you could buy a quadplex with an FHA loan using 3.5% down. And keep in mind, we talked about the loan limits in the past, right? So on a 2-unit, a 3-unit, or a 4-unit property, the FHA loan limit does increase. And so an FHA loan can be a powerful tool for someone that they could buy a 4-unit property, live in 1 unit, and rent out the other 3. And you can actually use up to 75% of the estimated rental income from those units to help you qualify for the purchase of that 4-unit. Now, keep in mind, when you're using an FHA loan, if you are buying a 3 or 4-unit property, there is a rule called the self-sufficiency test. And that is basically just to make sure that the property can pay for itself through the rent it generates. And you're only allowed to use 75% of the rents, not 100. So in that self-sufficiency test, if 75% of the total rent from all the units is enough to cover your mortgage, then the property is considered self-sufficient and you can buy it. This rule only applies to 3 and 4 units. On a single family, obviously you're just going to live there. On a duplex, this rule does not matter. You're going to live in one side and you can rent out the other. You don't need the rents to cover or be self-sufficient. So those are the basic property guidelines for FHA loans. Something to consider is that a lot of people have a fear of using FHA loans because they say agents won't accept your offer because FHA has stricter guidelines on the property. That's not always the case, but some agents do have a fear of FHA loans because they just haven't dealt with them. A good example of this is one of my clients last year bought a home. I helped them with their loan And I had to get on a three-way conference call to explain to the agents, both agents who had been in the business over 30 years, and they said, we don't really deal with a lot of FHA loans in our market. I just walked them through what the guidelines are and what the property requirements are, and the property was in fantastic shape, so there was going to be no issues. But they both had a little bit of fear just because they weren't educated. So it's really important you work with agents who understand the FHA guidelines and have actually closed transactions using FHA loans. I can't stress enough that, these agents, once they were educated, understood that this would be a very smooth escrow, and it was. The next piece of FHA requirements is just basic employment. You will need a steady job. Lenders want to see that you've been working for at least 2 years in the same type of job so that they know you can keep making payments. And keep in mind, right? Like, you can definitely switch jobs, but they will want to see that it's kind of in the same line of work, right? So if you're a teacher and you become a junior college professor, similar education, right? So if you're an engineer and you get promoted to a senior engineer, obviously that's same line of work as well, something like that, right? But if you go from an engineer to an entrepreneur, they're going to want to see 2 years of you as an entrepreneur making steady money. Those are the most common questions I get around employment when it comes to FHA loans. Another piece on mortgage insurance premium. So on all FHA loans, you're going to have 2 parts of mortgage insurance. The first is the mortgage insurance premium. So that is the monthly amount you pay towards your mortgage insurance. There's also the upfront mortgage insurance premium. So that's 1.75% of the loan amount. That's due upfront. You don't pay it monthly, it's just due upfront. Almost everyone adds that piece to their loan balance. So you can actually finance that, although it's due upfront. And here's a quick example of some numbers to give you a little bit better sense of upfront mortgage insurance and the mortgage insurance premium. So we're going to go back to this last example of a $500,000 home, 3.5% down. Here's your loan balance, $482,500. Your upfront mortgage insurance premium on this is $8,444, which gives you a total loan balance of $490,944. And then your monthly mortgage insurance payment is actually going to be broken down like this. It's 0.55 times that loan balance, which would be $2,700 a year. Divide that by 12 months, $225 a month. So now that we've gone over calculating the mortgage insurance premium, I actually want to go over calculating the whole monthly payment. I want to share a spreadsheet that I made to help you estimate your own monthly payments, everything included. Okay, so it's super important. You only fill in the blue cells here, right? The white cells will update on their own. Don't change those. So in this example, $500,000 purchase, 500,000. Down payment, 3.5%, 3.5. So these white ones auto calculate. And interest rate here, so you can just go ahead and Google what the interest rate is. At the time of this video that I was making it, the average rate on a 30-year fixed FHA was 6.5%. So I just put that in there. Here you have the term 30 years times 12 months. You can change this if you're thinking about a 15-year mortgage. Obviously, it would be half of this number. Once again, these white numbers auto update. So property taxes, these are estimated. I just do the purchase price times 1.23% and divide it by 12. Your mortgage insurance here, this is auto calculated. Homeowners insurance estimated $100 on a $500,000 purchase. You can Google this one too. It's going to vary quite a bit depending on what state you're in, right? Like in Florida and Texas, I'm sure your homeowners insurance is much higher. But if you're in, Southern California, this is a pretty good estimate. And then HOA, you can adjust this accordingly, right? So we'll just say this is 0. So now we're going to go actually into see if you qualify. So this has, if you just have a W-2 job, right? No additional bonuses. You just get paid. You get paid a salary, right? In this example, we said $120,000 a year. This could be for both parties. This auto calculates, divides by 12. And you can also mess with this if you have hourly pay. Just make sure that it shows guaranteed hours. So hourly pay sometimes is considered variable, but if you really want to just verify this calc, reach out to a licensed professional. Now, if your salary, this is really straightforward, right? So in here, I put, all your monthly salary, 10,000. And if you have other income, right, child support if you receive it, Social Security or pension, you put that in here, it'll calculate it. I pulled these numbers, right, exactly from the example from before. So car payment 600, student loans 150, credit card 250, no personal loans, no mortgage, child support. And I put mortgage here, it's if you own another property. So this shows all the calcs. This shows the monthly payment on that, and then it shows if you qualify. So going back into the front end debt to income ratio here, 39.41 qualify, back end 49 qualify for FHA. Remember, FHA needs a 47 or lower for front end and a 57 or lower for back end. So pretty straightforward. You can get a copy of this spreadsheet if you want. There's going to be a link in the description. Now that I've actually shared the spreadsheet and the quick calculations very clearly in that specific scenario, it's just an example. On 120,000 gross income, that person qualifies for a $500,000 home. And once again, please reach out to a licensed mortgage professional to verify your calculations once you're ready to get the process started. I'm recommending that you just get your calculations verified so you don't end up potentially putting yourself in a bad spot. Overall, I hope that after watching this video, you really understand the basics of an FHA loan so you can start to figure out what's the best option for you and your family. If you don't have 20% down payment saved up or an amazing credit score, I don't want you to feel hopeless, right? There are other options out there that can help you with home ownership. And I truly believe, because I've seen it, the FHA loan is a great tool for many people to get into a home. So make sure you know your take home income numbers and really figure out what's a comfortable monthly payment for a mortgage for you and your family. I have to disclaim this again. The numbers in this video were just for educational purposes, right? Interest rates change daily, down payment, property taxes, all that stuff will vary greatly depending on where you live and your specific scenario. So make sure you get educated and you find the right team to help you purchase your home when you're ready. Thanks for watching the video. I hope it was helpful. If you want to reach out to me directly, my email is in the description.